It's open enrollment time, so let's jump in and talk about the 5 mistakes you definitely don't want to make this year. Open enrollment is every year from November 1st to January 15th. However, dates may vary slightly dependent upon what state you live in and whether you use healthcare.gov or your state's individual marketplace. So if you're unsure, you can check out healthcare.gov and it will redirect you if applicable. But before we jump into today's video, please make sure to subscribe to stay up to date, and also make sure to click that like button, give us a thumbs up so we can get this very important information out there. And if you'd like, you can even sign up for notifications because we do release these videos on a weekly basis. And in today's video, we're going to be going over the top 5 most common mistakes people make in enrollment. But if you have any questions about open enrollment, please feel free to send us a message in the comments, and you can always give us a call at the number on the screen. The first incredibly common mistake we see people make all the time is all too understandable. It has to do with estimating your income for the upcoming year. So when you log on to healthcare.gov, it will ask you several different questions, one of which is to estimate your income for the upcoming year. Now, this can be especially difficult for freelancers and those who are self-employed, especially because their wages may change from week to week and year to year. It can be a little bit easier if you're on salary. You'll have a better idea of what to expect in the upcoming year outside of course, bonuses or commissions or anything like that, but at least you'll be able to provide a ballpark estimate. It's definitely much more difficult for those that are gig workers or small business owners. Now, that being said, it is incredibly important that you try to estimate as accurately as possible, because your eligibility for premium tax credits is determined by your household size and your income. Now, a premium tax credit is basically just a tax credit that is paid up front, and it's reflected in a discounted monthly premium. So when you're estimating your income, if you end up overestimating, it's likely that you'll be paid some of that premium tax credit back when you file your taxes. However, if you underestimate, you may have to pay it back when you file your taxes. So that could be a pretty hefty bill come tax time. Now, for many people who use marketplace insurance, the unfortunate truth is that it can just be very difficult to estimate your income for the upcoming year. So, should there be any changes in your estimated income, please make sure to log on to healthcare.gov throughout the year to update your information. And of course, if you are looking to lower your MAGI, which is your modified adjusted gross income, which is what healthcare.gov uses to determine your eligibility for premium tax credits, you could always work with an accountant, because again, becoming eligible for a premium tax credit could save you thousands of dollars per year. Another all too common mistake has to do with HSAs and HDHPs. So HSAs are health savings accounts, and there is a lot of buzz about them, especially in the FIRE community. And every year, the IRS sets a max contribution to HSAs for families and for individuals. So here's what all the buzz is about. HSAs have a triple tax advantage. So the amount that you contribute towards your HSA is pre-tax. So that could increase your eligibility for a premium tax credit and lower your tax bracket in general. And these accounts are interest-bearing, and that interest is not taxed. And as long as you withdraw funds for a qualified medical expense, that's not taxed as well. And the list is quite long. It even includes things like over-the-counter drugs like Tylenol or Benadryl. So again, the list is quite extensive. Adding on to that, you can even invest a certain portion of your HSA, and if you hold on to it until you're 65, because it does roll over from year to year, you can use it as you would a regular retirement account. So it's easy to see why HSAs are so very appealing. However, they are only available with HDHPs, which are high deductible health plans. Now, this is not in and of itself a bad thing, it's just something that you need to be aware of. So as the name indicates, high deductible health plans have very high deductibles. So they're not really ideal for people who have extensive medical needs or even young children who might have more and unexpected medical needs. So as great as HSAs may be, it would be a mistake to prioritize having access to an HSA over having adequate healthcare coverage. So that's slightly related to our next most common mistake, which is to not be lured in by those fringe benefits. It's very important that you make sure to prioritize which benefits are most important to you. And remember, all marketplace plans must offer at least the 10 essential benefits, and these can be found on healthcare.gov. The 10 essential benefits as listed on healthcare.gov are ambulatory services, emergency services, hospitalization, pregnancy and newborn care, mental health and substance abuse services, prescription drug services, rehabilitative and habilitative services, lab work, preventative and wellness services, and of course, pediatric care. In addition to all these benefits, many plans offer additional benefits as well. And it can be very confusing when you're comparing different plans. Sometimes they seem very similar and you're really not certain what the differences are. So it can be quite easy to be lured in by these fringe benefits. For example, adult dental and adult vision are not considered essential benefits, but a plan might offer, let's say, adult dental coverage. However, that's a great benefit to have, but let's say you've selected an HMO and your dental plan included is a DHMO and it doesn't really suit your needs. Also, bear in mind that things like dental and vision coverage can be used as add-ons, and then there's private insurance as well, which is much less expensive than people think. So again, make sure that you're prioritizing the benefits which are most central to your healthcare needs. When you're comparing plans on healthcare.gov, the first and easiest thing to compare is the premiums. However, this is another very common trap that many people fall into. But please do not select a plan based on the premium alone. That is not indicative of all of the financial factors that you need to take into consideration. For example, you need to look at premiums, deductibles, copays and coinsurance, and of course the out-of-pocket maximum. Now, your premium is, of course, the amount that you pay on a monthly basis to keep your insurance active. Again, that is the easiest cost to identify when comparing plans, so that's just one of the factors to take into consideration. You'll also want to look at your deductible. Your deductible is the amount that you have to meet out of pocket before your insurance begins to contribute to the cost share. And very often there is an inverse relationship between premiums and deductibles. So oftentimes you will see that plans that have lower monthly premiums have higher deductibles, and plans that have higher monthly premiums have lower deductibles. Now, this may not be a bad thing for you. A plan with a lower monthly premium and a higher deductible, this may save you money, especially because there are many services that are covered before you meet your deductible and many services that have a $0 copay. But don't take for granted the fact that you will have to meet that deductible should you have more extensive medical needs. And then, of course, there are copays and coinsurance. So these are the fees when you actually utilize your health insurance. So again, we want to look at the premiums, but we also want to look at the deductibles and copays and coinsurance because you want to have an idea of what your monthly spending will be and what your spending will be when you use your healthcare services. And then there is the out-of-pocket maximum. That's basically a financial cap that's set on a yearly basis. So once you meet that financial cap, if you meet that financial cap, your insurance carrier would be responsible for the remainder of the bills. This is mostly in place to protect you from major medical debt. However, if you're someone with more extensive medical needs, it might be beneficial to look at a plan that has a lower out-of-pocket maximum, even if the premiums are a little bit higher. There are many things to take into consideration when choosing the right plan. And now let's talk about the fifth most common mistake, which is waiting until the last minute. Yes, purchasing health insurance can be a little bit confusing, it can be stressful, and it's probably not something that you look forward to on a yearly basis. Add into that open enrollment is around the holiday times when people are busy thinking about other things, and very often people put this off until the last minute. Do not let this happen to you. You want to give yourself plenty of time to confirm if the doctors or specialists or hospitals that you wish to utilize are in network. You want to give yourself plenty of time to do your research and make sure that you give adequate time and thought to this very important healthcare decision. Additionally, if you decide to work with an agent or a broker, well, their appointments just fill up around open enrollment time. So if you put it off, you may find that you're unable to get an appointment slot. Now, if you do pick a plan that's less than ideal, you might regret it for a year until the next open enrollment. Or if you end up needing major medical care, those financial implications could be long-lasting and quite severe. So please, this is a very important decision. It's a very complicated decision, so give yourself plenty of time to make sure that you make the right decision. Now, as a last bonus tip, we'd like to remind you that you don't have to do this alone. As I've mentioned, and as you probably know since you're watching this video, healthcare can be confusing. Comparing those plans can be overwhelming, and it is very difficult to determine whether or not you're getting the right coverage for your needs. So as always, we recommend that you work with a broker. You're not going to pay more by working with a broker because their commissions are already part of the monthly premium that you pay. So whether you contact the company directly or work with a broker or an agent, your premium remains unchanged. Now, I will tell you that some brokers do charge an additional fee, but many do not. For example, we don't charge any type of additional fee for our services, and there are others out there that work the same way. You don't have to do this alone. You can work with an expert who can answer all of your questions and help guide you during the enrollment process. So that's our last bonus tip, is to please work with somebody who can help you during open enrollment. As always, if you have any questions, please feel free to send us a message in the comments or give us a call at the number on the screen. We are more than happy to help, and we are licensed nationwide. And as a last plea, please make sure to subscribe to stay up to date. Make sure to click that like button, give us a thumbs up, and of course, ring that bell for notifications if you'd like to stay up to date. Thank you so much. Have a wonderful day. Bye-bye.